Hi everyone, it's Paul Tilley and welcome back to EC1210 Macroeconomics. Today we're looking at Unit 7, Money and Banking. This unit is covered in Unit 7 of the D2L course and Chapter 8 of the textbook. Our key learning objectives in this particular unit will be looking at the functions and characteristics and the history of money. We're going to explain what money is and what it's not. And we're going to describe the main functions of the modern banks as money lenders. And we're going to explain how a small amount of cash can support many loans to create money, the multiplier. First, we'll look at money. What exactly is it? What's its functions? And a little bit of a history. First of all, we have to appreciate that money has three basic functions. It serves as a medium of exchange. It allows us to buy and sell things. What exactly is a medium of exchange? What do we mean by that? Well, it's how we trade things. Look at the barter system. If I owned a box of tissues and you had a bunch of paper towels and you were looking for tissues and I was looking for paper towels, I'd have to find you. You'd have to find me. We'd have to come up with some proportion of exchange. So we have to have this coincidence of wants. That's hard to do. It takes a lot of time to find coincidence of wants. What money allows us to do is to act as an intermediary. I would put a price on my tissues, you would put a price on your paper towels, and depending on the price issue and was an acceptable price, I could buy so much from you, you could buy so much from me for money. So that medium of exchange makes it so much easier than having to find that coincidence of needs that we need in a barter system. The second thing we need to look at in terms of money, it's a store of wealth. It allows us to transfer purchasing power from the present to the future. $1 today will be worth $1 tomorrow. Will it be worth as much in a year or 2 years? Possibly not. But effectively, reasonably within a short period of time, it holds its wealth. And the third key aspect that we need to look at in terms of a function of money is it's a good unit of account. We can use it to value goods and services, and we can record debts, and we can make calculations, and we can use it to exchange in denominations, we'll call it, to do that sort of thing. So those are critical aspects in terms of the value of money is making those functional benefits. In order for money to work, it really needs some key things. First of all, it has to be accepted. And I call it faith money, meaning that if I handed you a $50 or a $100 bill, you would have to believe that it's worth $50 or $100, whatever it says on it. That's how much you'd have to believe it's worth. Not only you have to believe it, but everyone else has to believe it. So this acceptance of money, if we have a loonie or we have a 5-cent piece or we have a dime or we have a $100 bill, it all works on the fact that we believe it's worth a certain amount, whatever it says on it. Money also has to be durable. If we look at new currencies that Bank of Canada is issuing, they're kind of a plasticky feel to them. The whole purpose is that they're designed to last longer. They can be washed out, they can be squished, they can be not easily ripped, so they're more durable. It also has to be portable. If you've ever carried around a pocket full of loonies or toonies, that they can be quite heavy. So we need to make sure that our money is as portable as possible, so it's light and easily carried. It has to be divisible, meaning that 250s make 100, 520s make 100, these sorts of things. So this divisibility has to be there so that we can make change. It has to be standardized. Standard sizes, standard prices, standard values, standard amounts. These are important. And it got to be recognized as being standardized. Another thing, too, it's not much good if people could easily copy it. So it has to be, something has to help be in place to prevent counterfeiting. If you look at a $100 bill, for example, or a $20 bill, or a $50 bill, you'll notice that there's a whole bunch of measures on them to prevent counterfeiting. And money has to be controlled by a central authority. If you look at Canadian money, it clearly says on it that it is distributed by the Bank of Canada. That is the Canadian Central Authority for money. Let's look a little bit next at the history of money. Money's been around for a long time. And it really started out because originally we had what's called a gift economy. I'll give you something, you can go use it. So a parent would give their child something. This is really what was known as a gift economy. and it involves commodities, handing off commodities. So in order to get what you want, though, you need to trade it for something else. This is where we emerged into what's called the barter system, where effectively we traded one thing for another. So Newfoundland, for example, had lots of fish. They used to bring it down to the Caribbean, and they would trade that dried cod for rum. So fish and rum were good examples of barter taking place 500 years ago. So widely valued goods could eventually become what's called commodity money. In fact, over the course of centuries, different commodities have acted as money. Salt, for example, beads, gold. These have all represented trading items that we would sub in for money. We started to see gold coins come about in the years before Christ. So 700 BC, we saw the first set of coins, and these were just gold medallions that had some sort of a figure on them, and that led to some form of standardization. Unfortunately, what we saw was a lot of people used to melt them down and add cheaper metals to them. So the gold coins would be melted, lead added to them, and they would effectively be devalued. And this led to inflation because people insisted on more money to buy certain things. We saw paper money come in the 13th century, and effectively it started out as glorified IOUs. Someone could buy something off someone effectively for some sort of a credit, and that little note would say, I owe you a certain amount at some point in time. These could be exchanged, so effectively it was really the start of paper money. The merchant banks started to produce paper money in the 17th century. They basically printed their own money, and this could be redeemed at their bank. We started to see checks come around too, and checks were just promissory notes to pay. The Bank of Canada in Canada stepped in the 20th century, and they took over currency production. So effectively, the Bank of Canada is an arm of the government, and they started to produce their own currency. We see early editions of Canadian money, the Dominion of Canada, were produced. So since 1935, really, the Bank of Canada has produced money. And again, we use the word fiat money. Fiat money just means faith money. In other words, it is the money that is accepted in Canada by law and that everyone believes it's worth a certain amount. As we moved along, we started to see people usually write checks that didn't take out actual cash. So there was a written document that would say, pay someone something amount of money. That would get put to the bank. The bank would read that and transfer money. Banks realized that, they could carry a certain amount of money in their stock and they could loan it out. This is how banks could make money. In fact, they could loan out more than they actually had in their stock. This is where we get into this concept of fractional reserve. This leveraging allows a greater rate of return for the banks, so obviously there was money into it. Next, let's take a look at what constitutes money. Well, money is anything widely accepted as a medium of exchange to buy goods and sell debts. Now, if we think of the money supply in Canada, if we think about, let's look at all the bills, all the money, how much is out there? How much money is out there? Well, there are a number of ways that it can be measured, and these number of ways are aptly named M1, M2, M2 plus, and M2 plus plus. M1 is really all the currency that's in circulation plus any demand deposits that are in banks. So demand deposits are really like checking accounts where money can be asked out right away. So currency in circulation plus demand deposits is added up to create what's called the M1 version of money supply. Now, if we add on one more thing, which is term deposits in chartered banks, which are like savings accounts. So if we add savings accounts to that M1, we get something called the M2, which is a broader measure of the money supply. And if we add on deposits in the near banks, such as credit unions and the like, that would give us the M2 plus. And if we take it even further and we add on kind of savings bonds and mutual funds, that gives us the M2 plus plus. So there's 4 levels of the money supply. M1 is the basic level, right up to M2 plus plus. What are some of the terminologies that we're beating around here? First of all, we used the word chartered banks. Chartered bank is really a Canadian commercial bank that have charters under the Bank Act. In other words, they're recognized in an act of Parliament. And generally, these are made up of the big 6 banks, the Bank of Montreal, Bank of Nova Scotia, the Royal Bank, and so on. We also have what's called the near banks. The near banks, or non-bank financial intermediaries, these near banks include things like credit unions, trust companies, and mortgage and loan associations. Often, they're provincially regulated, so they're not covered under the Bank Act, but they serve effectively the same function as a bank. Within the vaults of whether it be a bank or an air bank, we have things called demand deposits. And what a demand deposit is the depositor, the person who owns the money, can come in and say, I'd like my money, please. That means that the money has to be available on demand of the person who owns it. And these are normally what you would find in a checking account, which is very liquidy accounts. We also have what's called notice deposits. Now, notice deposits are slightly different than demand deposits in that you're expected, officially, you're expected to give notice that you're going to take that money out of the bank. So depositors really need to give a notice that they're coming to the bank the next day or the next couple of days to get their money. And these would include non-checkable deposits, such as what you find in the savings accounts. Now, the reality is a little bit different. If you or I go to the bank, we take money out of our savings accounts, no one's going to oppose it. But officially, the bank needs notice that you're going to come in and get that money out. And we also have what's called a personal term deposit. And term deposit is a term amount that you put in for an amount of time, say 6 months. And the idea is that you're going to hold it there for 6 months. In other words, you're not going to come looking for it within that 6 month period. Demand deposits are very, very liquid, right through to personal term deposits, which are not so liquid. So you can see here in this particular example how the money supply is added up, the M1, the M2, the M2 plus, and the M2 plus plus. And you can see that the money supply has grown significantly since 75 through to 2020. So now that we know what money is, what is it not? Well, anything that is currency in vaults or tills a bank is not considered part of the money because it's not out in circulation. Gold is not considered money. Financial securities, such as stocks and bonds, again, they're not as liquid, they're not considered money. And checks, credit cards, and debit cards are not considered money. They're a facilitation of money, but they're not actually counted into the money supply. So that's what we're doing here in terms of this money, is we're saying what gets counted into the money supply. Currency, gold, financial security, checks, credit cards, and debit cards do not get counted in the money supply. We also have to get an understanding of what the role of a financial institution is. They are a central place where either someone who's saving, someone who's borrowing, someone who's lending can go and use the funds. There's two broad categories, banks and near banks, and we've seen that banks are covered under the Bank Act. Near banks are usually provincially regulated, they're not covered under the Bank Act, but effectively they do the same thing. Banks make their money by taking our deposits and loaning them out. Now, one of the things banks can do is that they can actually lend out more than they actually have. And this is what's called the multiplier, okay? So if they have $1 in savings, they can loan out more than $1. Now, according to the law, they have to have a certain amount of reserve. In other words, they can't infinitely loan out money they don't have. They have to have what's called a reserve ratio, which is the fraction of deposits the bank must hold in cash. So we'll be talking about the target reserve ratio. Now let's apply it to the creation of money for banks. So if we look at a bank has a balance sheet, and the balance sheet, like every other balance sheet, has assets, which are really what the company, the bank, owns and what's owed to it. So the combination of that thing would be called its assets. The liabilities is what it owes outside. And the difference between its assets and the liabilities will be its net worth. In other words, its equity, how much the bank is actually worth. Now, we have this concept of the target reserve ratio, and that's the portion of deposits the bank wants to hold in cash. So it needs to hold a certain amount of cash, and that certain amount is usually in a percentage of its total. Now, the target reserve is really based on a target reserve ratio, say 10%, times the amount of demand deposits. So we can see an example here. Here's a situational balance sheet. Now, this is in millions of dollars, but I'm just going to use the raw numbers here. So we have assets in this particular bank. It has reserves of $10,000, loans to customers of $60,000, securities $30,000, fixed assets $20,000, for a total asset of $120,000. The liabilities and equity, well, it has $100,000 in demand deposits, which is liabilities, And shareholder equity, that is just basically the difference between the assets and liabilities, which is $20,000. Now, it has demand deposits of $100,000. And if it has a reserve ratio of 10%, that means that 10% of that, or $10,000, needs to be kept in the bank for the reserve, for people who knock on the door and say, hey, I want my money back. So effectively, they only have to keep $10,000 of it in the bank. The remainder, the $90,000 remainder, they can loan out. So generally, anything beyond the reserve ratio is what's called excess reserves, and that's what the bank makes money on. Those excess reserves, they can loan them out and earn interest on them. So excess reserves is simply the actual reserves minus the target reserves. So banks really create money based on this because they loan out that money. If someone, for example, were to come and deposit $1,000 in the bank, the reserves of the bank would go from $10,000 up to $11,000, and demand deposits, the liability side, will go up by $1,000 as well. And we would think, okay, well, if they have a 10% reserve requirement, that means $10,100 would have to be kept as the reserve for the bank. So the excess amount is loaned out. They charge interest on that, and that's exactly what the bank uses in order to make money. That all that money that they loan out, they charge interest on it. That generates revenue in the term of interest revenue. We can think of this in terms of the money multiplier. This is the increase in total deposits that would occur in the whole banking system as a result of new deposits in a single bank. So let's assume that they loan that money out, and people in turn take that money that they borrow and they put it in another bank. You can see that the total amount of money would actually increase. So the money multiplier is really the change in deposits over the change in reserves, or it's 1 over the target reserve ratio. The bigger the target reserve ratio, the smaller the money multiplier. The smaller the target reserve ratio, the bigger the money multiplier. So the money multiplier also works in reverse if under-reserved. Banks can call in loans, decrease deposits. The money multiplier will be smaller if the bank increases the target reserve ratio, if people hold more cash, if there's insufficient credit worthiness amongst applicants, if people don't wish to take loans, for example, in a recession, that would add up and create an excess money multiplier. So that's a quick summary of that chapter. I hope that you have enjoyed it, and please take a chance to review the chapter and review some of the example problems. As usual, if you have any questions, let me know.